Good day, ladies and gentlemen. Welcome to a lecture on forecasting and valuation, spring 2020. Let me put things into context around. Let me put a little context around this lecture. It was a recording of a live session that was held on Thursday, April 16th. It references the updated worksheet titled New Steel Dynamics Worksheet, April 16, 2020. I suggest that you open it first and get yourself familiar with it. This lecture as a whole is way too long. We try to make them into more manageable blocks of time, so I took the actual lecture and I brought it down into two pieces. The piece on forecasting and the piece on valuation. The first part is forecasting, and there will be a second video out there on valuation. Just to put it within context, this is what we need to finish off, and I reorganized it a little bit so that here is the forecasting and planning. What I'm recording now will be here, but this is everything about forecasting. This is the worksheet that I'll be referencing. There'll be another one down here on valuing methods. All of these go deeper, and what this video is to show you how to walk through it on the worksheet basis. So let's jump into it. If you have any questions, please make sure you'll let me know and ask them. Can everybody see a worksheet?
Yep.
Okay, so I have updated the STLD through all the data through 12/31/2019. I went through and looked at my assumptions. Now, when I built them, I had a broad assumption. I had them and I tried working with them. When I moved to the forecast, I realized that some of them I may not have done thoroughly enough, okay, or that didn't make sense to me. So you're going to start with those assumptions that you've already made, okay, and refine them if needed. So what I did is I laid out, this is what I thought the key metrics would be. Broad economy. Now, in the steel business, there are two other ones that are important. One is what's going to happen with steel tariffs, okay? And there's going to be a positive or negative on the company depending on what happens with tariffs. If they stay as is, it's going to no effect. Tariffs increase, the price will go up, and that will be good. Tariffs are dropped, it won't be good because it'll drive price down. Then I said, what's the other broad that is going to impact a steel company and contractors, and that's growth in infrastructure. So if we actually start building more bridge, fixing and repairing more bridges, doing all that, that's going to take more steel. So I said, if it just stays where it is, they won't be impacted. If it increases, well, they'll benefit. So I'm setting these up that I'm trying to get three different pictures or scenarios of what could happen. Now, what I did in my case is I broke the drivers into different areas. They have three main business segments. So what I did is I started with a base from my sales analysis of, and I'm using the prior year. So if you go back to sales forecast, or to where that come from? Oh, sales analysis. Okay. I had broken the sales down here by, I broke everything. Let's see if I can do this the right way without getting too confused. Okay, so I broke everything down by tons and brought it forward to the forecast. And then I set up what I thought was going to happen under the impact of these things. What did I think was going to happen? So this is the first and probably one of the more important steps is, do you have your assumptions, and I think everybody did, that was on the call, broken down into a rate volume, okay? Once you have that and can define movement on either side of a base, we move into making a forecast. Now, I've set these up that you can use these models, okay, and adjust them appropriately. But this is my forecast, BAU. We're doing 3, BAU, bull, and bear. So if you look, I put 2019, the volumes here. I didn't go back. And what I did is saying, okay, I want to forecast what's my volume for 20. So what did I start with? I started with this, 9841, and I'm multiplying it by this number. This number comes from my assumptions, okay? So that it's tied in. So if I decide to play with anything and I build it out like this, it will make a little more sense and easy for me and not have me input numbers. But I went through what I thought by business segment, what was going to be the increase in tons. Now, I did this uniformly over the 5 years. If you're looking at airlines, you may want to do each year separately. But basically what it does is it takes the tons from the history, it applies the factor that I think growth is going to be in tons. I bring in the new price based on its assumptions. And then I calculate the revenue from steel operations, which is the volume times the price. So these are all calculated based on this. And these assumptions all come back to the assumption page, which is founded on the actuals. So I did that for all 3. And then I added them up to get my base revenue. So this is my base revenue. So given no projects that the company's going to engage in, I calculated out by applying my assumptions to the rate and the volume, if that makes sense, and calculated out what my new revenue would be in each of these years. And this is the revenue if they didn't have any big strategic plans and they just said, oh, we'll improve customer service, and we just sort of plot along. This is what I think the revenue will be. Now, they have 2 big strategic items that they're working on, okay? And let me bring this up for you. To show you where I got. Okay, so I built this from the forecast assumptions that I found out what are they doing. And I think you did this already. And here's their investor presentation. And I'm going through it. Okay, what are they going to do? Here's their strategic plan. Okay, they're going to build a new flat roll steel mill. It's going to cost $1.9 billion, mid-21. Now, you don't just start building that in 21. This is underway. So we knew that was the big one. Here's one. The next one is they're going to mid-20, going to spend $140 million in the galvanizing line. These other 4 happened in the past, but we know these are the key revenue drivers they're working on. So once I knew the drivers, and let me just go back. I kept going down, and here for the Texas flat mill, they're going to add 3 million tons of annual capacity. So I had some volume numbers. So on the new plant, I know in 20, nothing's going to happen because they said it's going to be mid 21. So what I did is I started with 3 million, which is the capacity, and said in the first year, they're only going to produce 30% in a BAU. Then I went down and said 65%, 80, and 85. Now, these are my estimates of what they would do. Okay. And I did that for both bear and for bull. But let's just take this. So these are the volumes that I think they're going to produce. And if you go back over here, you're going to see I put the poundage in, and I'm using the same price that I did up here. And I multiply that out, and that gives me the incremental revenue from strategy 1. Okay. And I calculate that out. Now for them, this is a big deal. They're making a $1.9 billion investment. Okay. Then what I did is, what's the galvanizing line? That's the other one. Again, I picked up all of the tons. That's the second strategy 2. And I combined them to get a revenue of 11,478 for the first year. So it starts with my base, applying my general assumptions. Then I bring in the two strategies to come up with a new number. Now, they have a different impact, these strategies, a much bigger impact over time. But that's what transformational or big projects should do. You may not have, depending on what you're working at, there may not be anything this big. It may be much smaller. But for this company, it's big. So that's the first thing I did is I now have my total revenue that I estimated. Now, revenue is the starting point for everything we do. Okay? Everything's driven by it. We can't figure out income. We can't figure out cash flow until we have revenue. Now, these are numbers. They're not exact numbers. They're a set of numbers based on my set of assumptions. Now, if I move over to the bull forecast, there we go. It's the exact same worksheet. The only thing different is I'm using a different growth rate. Okay, so I'm still going back to my assumptions, but this time I'm doing my assumptions based on the bull case. So in my bull case, I'm going to grow by 4, 2% flat in BAU, and down 2% in bear. So I'm doing the same computation, same format. So when you go to do it, whatever you're going to use for your base indicators, okay, if it's hectoliters of beer and price per hectoliter, that's whatever it is, you're going to use these. The format is exactly the same. You're applying a different set of assumptions. Now, I've only talked about revenue, and we come up with some big ranges. So the next step, once you do revenue, you want to do a little test to see, are you within a range or within reason? Okay. And that's if you go to the page statistical forecast. What I did to give you a sense is there is this, if you go to data on the top, you're going to see there's a forecast sheet. Okay. And it's a worksheet that gives us different options to forecast. So what I did is I put in the historical, then I ran this model, and it's a statistical forecast using time-based data, the history, and use a methodology, for those of you that remember everything from quant and stats, a AAA version of the exponential smoothing algorithm. How many people remember that? Anybody? I didn't think so. But it's in the model, and all you have to do is put the numbers in. But what it's doing, it's telling us that statistically based on this history, with some smoothing, it's going to give us a forecasted value for sales. It's also going to give us an upper confidence level and a lower value, lower confidence bond. So based on the statistical model, there's a 95% chance that revenue will fit with between, in year one, between 9.8 and 13.4, 10.5 and 14. Now this is purely statistical, but if you come over here and you look at what my BAU is, and look what the forecast is, I'm pretty good. Now, when we look at the bear and the bull, we are still within that 95% confidence range. So this is, the model is validating that at least in year one, we're within the statistical realm of probability. And if we move forward and you look, I'm pretty tight. The forecast in BAU is close in the first 3 years, and then it diverts. But it diverts because what I've done is added in this much more revenue, which isn't statistical. This is a new action item. So when you're doing this, you want to do this and compare and say, in the first year or two, you should be pretty close within this range. If you're outside of that range, go back and check your numbers unless you have some big event that's going to happen. Okay, so this is a check to tell us statistically, are we in the right spot? Okay, I want everybody to think about that for just a moment. Any questions? Does that make sense? Did I confuse you? Okay. Now, let's go back to the forecast again. The assumptions, the most important work is what you're doing on the revenue. When we started, one of the first things we did when we went off the broad is we created a common size income statement. Okay. So when you think about this, the first line we're going to have is cost of goods sold followed by gross profit. But when we know, and we've played with the common size, we know that there's a percentage historically that our gross margin or our cost of goods sold has been from that common size income statement you made. So I made the assumption here that 85% cost of goods sold, that's the historical relationship that they've had for the past few years. So 80, if I'm looking at it historically, around 85%. I said, okay, if things get better, their cost of goods sold will go down because they're using more of capacity and fixed costs are fixed. If the scenario goes the other way, they're not going to be using their plant, but they still have the cost, those fixed costs. Okay. So that is the second biggest item. So if I make my assumption that that cost of goods sold is either the same as what it has been for my BAU and I go up or down, I can now go over here, build my formula to just take whatever I add up in revenues times the 85 and compute my gross profit. Does that make sense to everybody? Okay. Now, I did that at 85, but then when I went to the bull, I dropped it down to 82. When I did the bear, I raised it on up to 88. But these are all formula driven. So when you're constructing yours, I might suggest, wait a minute, if I already have this built in that this is, I've computed this for you, well, why don't you just make sure it's your revenue number, you change this and let everything else just flow mathematically. Okay? So that's how I came up with my gross profit. Now, at this point, I'm still totally dependent, the quality of what I've done, or I won't say the quality because that's the integrity of it is based on a set of assumptions that I've made around revenue. And everything else, I looked at these two expenses, SG&A and profit sharing, back over to my assumption. This is what they have been. So I said, okay, for my BAU, I'm going to use the historical number. I think if sales go up and things are really good, they're going to spend more money. Okay. And if you have less money coming in, you're going to probably cut back on costs. So I said, in that place, I'm going to use 1% for the bear, 1/4, that's history, just keep going. And then 2% for the going forward. I then looked at profit sharing and said, well, it's a percentage of revenue. And most profit sharing plans are a function of revenue. So I let that be there. I said the same percentage. These other three things here, amortization, I said, well, I'm not planning any more acquisitions, so the amortization would be flat. Interest expense, I held flat, the same dollar amount, because I assumed that cash flow is going to pay for cap expenditures. And then I'm going to use the tax rate as the same because that's a function of income. So now when I come over here, again, these are all formulas. I did the history. Okay, that was 140. So I took the revenue times the factor, and this is right out of my common size, and I calculated this 1.4% of the revenue is going for admin. I then went to profit sharing, let that at its number. These I held flat, as you can see, there's no gap. I did have this thing here called depreciation. Okay, and when we look at that, what I did is went over here in my set of assumptions. Remember, it told me how much each project is going to take and when it's done. So I assumed that some of the costs for both would be in this year and the rest would come in next year. So I knew these are going to be the capital expenditures. What am I going to do for depreciation? I don't know what the number is going to be. I made it up. I said, I'm going to depreciate these over 10 years. What should I depreciate things over? Chrissy, what do you normally depreciate an asset over?
It's salvage life.
Salvage life or?
Yeah, the useful life or the
useful life.
value?
Sure.
Useful life.
I think it's 10 years. If you think it's 12, use 12. But we have to estimate a useful life. And that's how I computed the depreciation. And I said, okay, I'm making assumptions as we're going here. I said 10-year life. I want to change that and say 15 years, boom. All I do is go back here, change that number from 10 to 15, and boom, everything changes from there. So what I did in the BAU is I added the base, which is this, to the incremental and came up with a depreciation number. Pre-tax calculates, input of taxes calculates because I decided to use the 22, and I've also put in number of shares, and I said there's no more buybacks, and these are the earnings per share. I then went and calculated the free cash flow because now I made the assumption that net income equals cash flow from operations. Okay. And that's an assumption I made. I'd tell you to make the same assumption. We add back depreciation, subtract out cap expenditures, the incremental ones, and we see what the simple free cash flow is. I then do EBIT, interest before interest and taxes, and this is all calculated. So you don't have to do anything other than make sure this, you put in the revenue right, you make a set of assumptions. And I did that for bull and bear.